So you want to be able to enter and exit trades like most professionals out there. There's basically three steps. Anytime that I look to enter a trade or even get out of a trade, I'm looking for three things to happen that gives me the confidence to want to go ahead and get into a trade. Exiting the trade is a lot more easier than actually entering, okay? Because before we take a trade, we've got to kind of size up the market in a sense and knowing the high probability areas where to take trades from. Trading supply and demand. So what I want to show you is just basically three ingredients that I look for that kind of bakes up the recipe for me to look to get into a trade that helps me decide which zones make sense and identifies also the three ingredients that gets me into a trade. So we're talking about a breaker structure. Is there a gap back at the zone? People always also ask me, well, Mike, what do you mean by high probability and low probability? High probability trades, for me, for example, are where there's an actual gap back at the zone, pretty much where there's a imbalance resting where the market hasn't been mitigated yet at, and the zone hasn't been tapped into, not even for the first time. So when I see that, just like, for example, this demand zone right here, and all demand is, if you're a first-time viewer, it's just aggressive buying or selling in the opposite direction, okay? Aggressive selling. And when the market comes back to a zone, if it's untapped, then that raises the stakes and piques my interest because it becomes a more of a high probability zone. And if you look here, this here is a high probability zone because the market never came back to it immediately. Meaning that once it pushed away, the candle that broke above this bearish candle to the downside, it didn't come back and fill in or tap back into the wick of that bearish candle. So the market pulls back to it after it runs to the upside. We get aggressive buying. That's momentum push to the upside and pulls back. So write these three things down because the first two have everything to do with, okay, is there, well, let's talk about like this. First, you want to be able to identify structure, okay? These aren't the three things, but you want to be able to depict, is the market moving to the upside trending or is it moving to the downside? Meaning, are we breaking structure to the upside or breaking structure to the downside? Now, when I talk about the three things that I'm looking for, is basically, is there a breaking structure that occurred where the market just broke above in this case here, because we're moving higher, the last or previous high that it just made, the most recent high that it just made. In this case here, it made a high here, it pulled back, and it broke through that recent high that it just made. So that's a breaker structure. So if and then the number two, write this down too, is there a gap, meaning an unmitigated area back at the area, right, where the market broke structure to the upside, meaning an area of demand, where the market hasn't tapped into it yet. Mitigation, meaning unmitigated, mitigated zones, that basically just means has the market moved away from the zone and not tap back into it to where an unmitigated zone, more likely there's orders resting on the table because of the aggressive push to the upside. So, you know, when you see things like this where the market just takes off real quick to the upside, more likely there's orders that haven't gotten filled. So on the book, so when they get back there, they're probably going to try to, I speak of the institutions are going to look to fill the remaining portion of their orders and continue pushing the market higher, just like it did, came back to the zone and broke higher. Now this is real time off a 60 range chart. I trade range-based charts. But again, the three things that I look for, is there a breaker structure that occurred? Secondly, is the zone mitigated? Has it been tapped into? Or is it unmitigated? Meaning the fact is there a gap back at the zone? Unmitigated zones or high probability zones. Mitigated zones are ones that are lower probabilities, but it still that doesn't mean that the market won't tap back into them for a second time and then still reject, okay? We can't control the markets. We just trade based on rejection and confirmation. All right. And number three is basically just boils down to once the market taps into the zone, is there rejection at the zone? That's what we use our lower base chart to get us into a trade, meaning we scale down to a lower base chart. For me, it could be my 24 range or even a 12 range chart to see if I'm getting rejection, meaning a break and close of the candle in the opposite direction to go long. In this case here, if we're going short, break and close of the candle in the opposite direction to go short. But number three, also, you might want to notate this. If the market doesn't close, for example, into the zone, I mean, we close deep into a zone where it's pulled back and broke into a zone, then it just comes to it and wicks away like it did right here. So we got the wick, a candle didn't close, like a bearish candle didn't close into the zone, but it wicks away from it and then closes to the upside. That's a bullish hammer candle. That's still giving us a indication that the market is still bullish, wanting to push higher with momentum, and we see that it continues doing that to the upside with these bullish candles. So number 3 as well, this part of the rejection that we look for confirmation. We want to see, did the candle close into the zone? Okay, is there one that closed into the zone or not? If the market just came back to the zone with a supply or demand, in this case here demand, taps into the zone with a wick of a candle and then moves away from it, all they're doing is testing it and then showing you that, hey, we're not done. We don't want to go any lower. We don't want to start breaking lows. We want to push higher. So those are 3 things that I'll look for as far as entering a trade. Exiting is basically when the market taps into a zone and we haven't broken any structure to the downside. All right, in this case here, on the 60 range chart, the beautiful demand area, the market comes back to it. I'm looking to see, did the market take out any levels? Did it break through any area of structure back to the downside? If not, then I already know more than likely, I'd say probably 90-95% that they're going to run that high right there, because the market has not, for one, made a low, meaning it hasn't broken through any prior lows to the downside when it came back to the zone. All right, so this is the part where we're trying to look to where do we exit the trade at. In this case here, I would exit a trade back at this high up here that it just made once it tapped into the zone, because once it taps into the zone, we can see that the market did not take out any area structure back to the downside, all right, and hasn't broken through or taken out any major lows, meaning running through levels, taking out any minor area structure back to the downside. It hasn't done one or the other. If it hasn't done that, then we can almost bet our bottom dollar that they're going to continue wanting to push higher, as you can see here. All right, so just like right here where the market pushed up, made a high here, pulled back, and it broke structure right here above this area at 18,752. Look, it was making these higher highs and higher lows. All these little swings here were aided in the structural break here above here. When the market pulled back, yeah, it took out this little small low, okay? This little swing of internal structure on the inside of this bigger swing right here, okay? But all it did was, if you see that, it did come to the zone, and yes, this would have been a zone right here, meaning a demand zone, and it did break into the zone. It came down and broke below it with the wick of this candle right here. But if you know about trading and you spend some time, all that is going to be is a liquidity grab, because they broke below it, wicked it, bullish momentum back to the upside, and then they were aiming to push for higher. They were trying to stop traders out because they knew more than likely people probably had their stops resting right back here at the back end of this candle right here, because as the market started breaking to the upside right here, after running back to the downside right here, they knew people probably went long right here, running stops to continue pushing the market higher. And where we're going to aim for right here at the top end right here, because we didn't get a break and close of a candle to the downside where it started taking out and closed below the low right here. It just wicked that area, grabbed liquidity, broke back to the upside, and came back and pushed higher. So again, the 3 things that I'm looking for, number 1 is is there a beautiful high probability demand zone or supply zone, okay, when we're talking about trading. But number 1, there must be that break of structure, like we got here, a break of structure, pull back, break of structure. Now we got another break of structure to the upside, okay. Now this right here, if the market comes back to this zone right here, this is mitigated, because look, a candle closed above here, broke above the last bearish candle to the downside with this bullish candle here, and then the third candle that came back. The wick of it came back and touched the top end of that bearish candle. So this is a mitigated low probability zone if the market comes back to it. But number 1, is there a break of structure? We got 1 here, 2, 3, right? And then number 2, is the zone mitigated or unmitigated? Mitigated meaning that it's going to be low probability, unmitigated, untested, higher probability. And then number 3 is just basically once the market taps the zone, we're trying to identify where to get out at. If the market has not broken through and started taking levels out back to the downside, where it's basically taking out, running lows, okay, and breaking structure lower, then you can almost aim for and know that the market is going to push higher and run the last high that it made, okay? Like right here, broke higher, we didn't close and start taking out and start making lower lows. Yes, we did come down here and break below this area, and it made a low here, but it didn't break and close with a candle, okay? This is just an area of liquidity that they ran with the wick of that candle and pushed back higher. So when we see things like that, where they didn't break and close and start making new lows on the close of a candle, then we can aim for this high right here at 65. Again, this is on the higher base chart here. You want to scale down and move down to your lower base chart. I talk about the strategy broken down, meaning from once we mark our zones up, like I did right here. This is a zone. I took this trade here, just scalped it back up to this high right here. And I got into it late. I will say that. But I was able to pick up, several points. I think it was like 8 or 9 points just quickly. Okay. I could have grabbed more than that. I could have probably picked up, what was it, from 80 to here. I probably could have picked up at least those 15 points right there, or 10 at least. But I just scalped for like 7 or 8 points right there because I got into the trade late. I think it was about 8 points. But anyways, this was a supply area. I mean, a demand area right here. I would have taken this trade right here too. But the thing was that this happened at 3:30 this morning during London time. But I didn't, I wasn't awake to take the trade. So what I'm trying to say is look for and make sure that you're focusing in on the structure of the market. That's the most critical part of trading. But the 3 things that I want to talk about as far as entering and getting into good trades like the pros do, it really is being able to follow suit and understand what's going on with structure breaks. For me, the way I identify things is, do I got to break a structure? 2, is the zone tested or untested? And then 3, once we tap into it, where am I going to exit it? I'm looking to see, did it take out any major, did it start running lows, okay, and start breaking structure to the downside? If not, then I'm aiming for the most the most recent high that it made if it's pushing higher to the upside, meaning breaking structure. To the downside, if we are looking to go long, as long as it doesn't start taking out, swing level highs back to the upside and start breaking structure to the upside, then I'm going to be aiming for that last low that it made, okay? And looking for it to break structure back to the downside. Like right here, it pulled back here. We're going long. No structure breaks to the downside, taking out no significant lows. So I'm going to aim for the most recent high that it made to break structure above there. And we're doing the same thing in reverse if we are moving lower and looking for supply setups. That's simply it, guys. Just 3 things. That's really what I look for as far as entering and exiting. Again, the strategy and what I look for as far as marking my zones for my higher base chart like I do right here in my 60 range. And then I'll move down, say, for example, like right here's the trade I took right here. Let's see. It's for 8-point scalp right there. It wasn't much. I should have got in right here. I got into the trade late. But either way, I was able to pick up 8 points right there. Just for a quick scalp off the NASDAQ around about 8:30 this morning. No, shortly after that. And as you can see here, this is that 60 range zone that I marked up. Marked the zone up off a higher base chart. Then I scale down to a lower base chart to see if we get rejection, breaking close of the candle, you can go long. Or you can wait for in this case here, the market pulled back. Once it pulled back to the 60 range zone, it also pulled back to, you see here, a 24 range zone, okay? Demand zone. So when I see things like that, I can look at my 60 and say, okay, it hasn't broken or taken out any, major lows, breaking structure to the downside. On the 24 range, it may paint a little bit different picture, but I'm going to take the trade in the direction of what's going on based on the higher base chart. Once it taps into, the zone on the 60 range, I look at my lower base. It's also tapped into a 24 range zone too. Multi-chart confluence, more confluence you have, the trade is going to probably more so work out in your direction. And we have an unmitigated zone that hasn't been tapped into as well on the 24 range. When it pulls back to the 24 range zone just as well, look for the break and close of the candle because we got multi-chart confluence to go long. We look back over at our 60 range chart and we see again that it hasn't taken out any major lows. We just aim for that last or previous high it made. It's simple as that, guys. Those are the 3 simple ingredients that will raise the probability of the trade working out in your direction and looking as far as to when to enter trades and to exit trades just as well. So kind of jot those things down, those 3 things down. Again, the breaker structure is there a gap back at the zone? Is it mitigated or unmitigated? And then 3, looking for confirmation of rejection. And 2, on your lower base chart and looking at the higher base chart to see where can the trade go to be able to know where to exit. Is there a high that it just made? And if so, well, we know it's going to be a high right here. But the thing about it is that did it break any area of structure when it came back to the zone, moving back lower, taking out any lows? No, it didn't. Okay, it came to the zone and tapped up and moved away. You'll see things like this unfold, especially when the market is trending in a bullish or trending in a bearish direction. All right, same thing here. This was the zone right here. Market comes to it. Now this is a liquidity grab. This wasn't a demand setup. It would have been had the market came to it, rejected it, and broke higher. What it did is came to the zone again and it wicked it below it. Didn't close and break below. Okay, it wicked it. All right, it did break below, but it didn't close, meaning get a closure of a candle, taking out lows to the downside. It wicked it and then moved higher. So hopefully you understand what I'm trying to say there. But I hope this video, helps, some of you use traders out there, because I know you guys have asked me, Mike, what are some things you look for as far as entering and exiting your trade position, especially if the market is trending in a specific direction when it comes to trading supply or demand. So I just wanted to kind of talk about that, because that's going to give you, an idea of how to do so and become more seasoned at what you're looking for and how to get into trade setups. All right. So, but if you found, some interest and value in this video today, please take the time to go ahead and sub to the channel. I have loads of valuable content here on the channel that will definitely help you out if you spend time taking a pen and pad and jotting things down. Also, I have if you're interested in getting my trade breakdowns where I walk you through trade setups more in detail and trades that I've actually taken, and I posted over on the Discord community. I do post a lot of my trades on the Discord community. The Discord is free to join. You can find the link down in the description portion of the video. Scroll down, look in the description. You'll see a link that says join the Discord. Right below that, you'll see a link that says become an elite member. If you choose to become an elite member, you get the trade breakdowns, okay? You also get my video playlist, which is a link-by-link series of videos that I hand-selected off the channel and made them private to the individuals that wanted to join or have already joined. Thank you for all you guys that have joined, because your efforts have supported me in creating valuable content that aids you. The content that I make has helped people out tremendously. I mean, time and time again, it's shown over on the Discord community, people passing evaluations or, funding their own accounts, things of that nature. And they're showing great improvement on watching and learning through the videos. If you want to become an elite member, a lot of you guys are, and you've learned through watching and seeing the actual trades that I take as I break those things down, it's only $6.99. So scroll down in the description portion of the video, right below the link that says become a Discord member. You'll see a link there that says become an elite member. Click on that. 2 tiers will pop up. Choose the one for $6.99. It's a month. It's basically, you pay for a monthly basis for $6.99. You're paying more than, not more. You're paying less than a price of a cup of coffee on the day. Think of it like that. Most people spend more than $6 or $7 a day on a price of a cup of coffee or for a breakfast sandwich or a lunch sandwich. So in this case here, you're getting all this valuable content and receiving the trade breakdowns, the video playlist, the other perks and rewards that are part of the YouTube tier membership program. But for $6.99 is something that will help you along in your own personal trading journey as well, because I talk about stop loss placement and management, where to take profit at, what I was thinking about, and why I took the trade. So it's helped lots of individuals out. So something to think about. Again, scroll down to the description portion of the video and you'll find that link to become an elite member. All right. Appreciate it, everyone. If you haven't subbed, please take the time to go ahead and sub. Make sure to turn all your post notifications on. And last but not least, if you do not mind, please drop a like on the video, okay? It helps the channel out, helps me continue pushing out this video content and getting it out to the masses of people that are really, really interested in becoming profitable traders and consistent on a daily basis. Take care, and I'll see you in the next one.